Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. Well, it is Thursday. That means we get jobless claims today. There's also a 30-year bond auction and PPI. PPI, the big one here. Sorry, News Squawk is talking in my ear right now. So let's come over and kind of review what happened yesterday. Well, yesterday was quite the day with the ZN here. The CPI report, hotter than expected. Although, like, again, this is kind of a funny one because I think almost everybody on the street was expecting core CPI to be spot 4. Like, I know that the consensus expectation was spot 3, but everything that I read was spot 4. So, badoosh, we got hammered. S&P 500, you know what? Like it was bad, but they recovered. It's okay. It's okay, everybody, right? I don't know. I kind of think there's a lot of. Well, we'll talk about that after this. Oil. There was a bit of noise overnight about like Hamas is agreeing to the deal or they're not agreeing to the deal, and so I think it's still going to be volatile here in oil. I tell you what, though, like a move like this is kind of like really unusual in oil. I've never seen that before. Like such a clean and clear trend in that asset. Okay. Gold and silver kind of after the CPI getting really hammered, but then recovering and pushing higher today. And silver actually looking pretty good off of that one. Copper really moving. Ooh, copper just looks so good to me. I tell you what, copper either looks like dismal or amazing. I don't know what the deal is with it. Okay, and Japanese yen, well, they've come back down, but they're still kind of like towards the longer run trend line, so yeah, it's okay. And the dollar at 107.7 essentially here. Bitcoin, man, I read so much pessimistic stuff about Bitcoin yesterday. I don't know what the deal is. It's like, okay, you're down 5% from the highs. Well, maybe it's more than that. Maybe it's more like 10% from the highs. And you're freaking out? Like, I just... Okay. Those guys are really... You can tell that the boys in Bitcoin ain't the... I don't think that they're the diamond hands type. But, so, that's what's going on over there. Again, we have PPI coming out. We also have jobless claims. Let's see here. What are the numbers that we're looking for? US PPI month over month, spot 3. US core PPI month over month, we're looking for spot 3. Versus a previous rating of 0, by the way. This week, we're looking for a US initial jobless claims of 215K versus a previous reading of 219. I actually think, given the layoffs that we've seen and some of the other stuff that's going on, that's going to be low. I think it's going to be more like 230, but we'll see. Keep an eye on that. Continued jobless claims, 1.881 million is the consensus expectation. And again, we have a 30-year auction today as well, which probably will affect the curve a little bit. Good morning, Uzi. Well, here comes the number. I'm going to blow my nose. Okay. Okay. So I got headline PPI at spot 4, but core at spot 3, in line with expectations. Initial jobless claims lower than expected, 213 versus 215. But the continued jobless claims a little bit lower than expected, 1.85 versus the 1.88 expected. So all of those numbers are good. And I am not sure why the treasuries shot up like that. That is a little bizarre, actually. Year-over-year number was higher than expected. Headline PPI was higher than expected. Core year-over-year was higher than expected. Core PPI was in line. Initial jobless claims was better than expected. All of these numbers are showing like a stronger economy than expected. Why did the treasuries buy on that? I don't think I've ever seen it that far off. That was a little bit. Now, the volume on it is a little bit fishy. I don't know. I think somebody screwed up there. I think somebody screwed up on that one, man. Let's just remember yesterday's lows were all the way down at 04, so... It was about 10K long, and now they're washing it out. I don't know, guys. That's really curious. Brannigan Barrett says Trump reciprocal tariffs will be bullish for markets. Okay. That's curious. So for those of you that aren't aware of that, today, Donald Trump is expected to sign reciprocal tariffs, which is to say there are countries, like most notably India, that have tariffs against U.S. goods that the U.S. has never levied tariffs against them. So the thing that Trump is going to sign is, in every case where they are putting tariffs against us, we are going to raise our tariffs up to match. I think it is a bit of an escalation, if really not as much an escalation as it is a broadening of the trade war. We can fight everybody now. I don't think that these particular countries are like ones where like the US imports a ton of stuff, so like I don't think that it's like a huge deal, but I think markets probably do, react. The guy at 13.5 must have, I don't know, man. I don't know what this thing is doing. We're coming back up. That push, there must be something else going on. There must be something else going on, because that makes no sense. It makes no sense based on the news. Like I keep looking at it to try and see like which of these numbers was actually kind of low. Because I don't know, man. I think this is a spot where like my past traumas will come out, right? Like this reminds me of when the Silicon Valley Bank fiasco was going down. And we're like, why are they buying it so aggressively? This makes no sense. What's going and there's something was going on. Like a bank was literally failing, and we didn't get any information about it until after it basically already happened. Right? We were not the informed traders in that particular instance. I think based on all of the economic data that we just got, PPI inflation a little bit hotter than the expectation, although I kind of expected that. And the jobless claims lower than expected. How is that a buy? But the 10-year treasury in particular is net buying off of that. Does not make sense. Maybe I should go skiing today, man. So my wife works today. I went skiing yesterday, and it was some of the worst skiing conditions I've ever been in. It was so bad. It was ice. It was ice. Kind of windy. Extremely cold. Oh, it was bitter. But you know what? I still enjoyed myself. Ooh, I met this guy on the gondola. He's talking, and like I immediately recognize the accent. I'm like, this guy, he's from New York. And so I get talking to him, and it turns out that he used to trade in the commodity pits. I didn't get to talk to him for very long, but I met this guy on the gondola that used to work in the commodity pits. And he told me that he used to work with Gary Cohen when Gary Cohen was a commodity trader, and he wasn't very impressed with him. So there you go. I actually wouldn't surprise. I mean, like being CEO, completely different game from being a commodities trader, right? But anyways, there's going to be two feet of snow this weekend. But because it's President's Day weekend, I get the blackout. And I think that the blackout is starting on Friday. Let me see. Let's see here. Should have gotten the guy's name for sure. Tried to look him up. Oh, wasn't thinking at the time. 15th through the 17th. Oh, so Friday is not blacked out. I could go on Friday. I will ask my mom. She'll watch them. They're still buying it. Dude, wait, are they going to get to the high? Like to 24? Fed is still seen waiting until September to cut policy rate. It is a 30K net buy. Japanese yen is really rising here. And the dollar is dropping like a rock. So perhaps something to do with tariffs. I mean, the only thing I think I can do in this situation is buy it and hang on. But since I am not the informed trader, I'm going to sit on my hands. Yeah, it's about 35K net by now. I'm starting to see a little bit of selling coming in. They're hitting into a huge iceberg there. Oh, that's a big iceberg. This is really a wild move, man. Okay, it does look like it's subsiding a little bit. Funny how there's a volume spike on the basic volume histogram. So my indicators aren't necessarily intended to show that. I will say though that there is a very high correlation between the total number of level 2 changes and absolute volume, but not always. And it's kind of those situations where you see a lot of level 2 activity and not any volume that are the interesting ones, right? Are the ones that kind of alerts you to. What do you mean, do you consider a buy stop as a net buy? I mean, a buy stop order is a buy order. So, it looks like that the meta order has kind of petered out. I think that kind of strong sell back into it and hitting into that iceberg was like the major order that was pushing us up. I am also kind of starting to see liquidity hold behavior. So in this case, I would expect a volume profile to form here like this, right? There's already a bump, you know, a lot at 21.5. So it may be that point of control becomes the center of that that volume profile. So in this case, so, you know, we're talking about we can predict the volume point of control before it happens. But in this case, so much traded there at that spot that, you know, it's just already there. So this wouldn't be a good example for that. What are you talking about? Since I came across a Larry Williams synthetic VIX, I just noticed just about anything can be simulated to a high correlation. Yeah. Or you're saying that, like, you have a complicated indicator, like the VIX. VIX is a complicated thing. You, like, pay data to get it. There are other ways to kind of get something that approximates it or does a good enough job. I think in most cases that's true. I'd say that, like, so like the level 2 changes, I think you're singling out the wrong one, right? Because that's like the most basic one. And the reason that you single out the level 2 changes is if somebody is like quote stuffing or spoofing, then what you'll see is a huge spike in level 2 changes and like no volume going through. I haven't seen it in a while, though. It doesn't happen as much as when we first created these. I think that the things that you should be more interested in should be like these the resting order imbalances, market order imbalance, which is kind of a version of cumulative delta, right? And the largest resting orders. I would also say that, well, the resting orders, the way that I filter is a little complicated, but it's not that complicated. I really think that if you can program market depth in NinjaTrader, you could probably program a metric that would be relatively close, right? So the advantage to my indicator versus doing it yourself is, one, mine has been tested and optimized over several years. There's definitely mistakes that I made in them and have fixed over time. And the caching saves it to a file and loads it back up correctly when you reload the chart, so you can do backtesting on it, right? That's what the value in the indicators are. But at the same time, I haven't seen anybody try and copy them. But I tell you, if somebody like completely duplicated all of the caching features and made it free, I'd be extremely impressed. I really can't imagine anybody going through that much work for free. I gotta say, it really is like an expertise thing. Like, there are so many bizarre nuances in Ninja. Like there are so many of these kind of nuances in C# and NinjaTrader that I have found mistakes in NinjaTrader's stuff, right? Like some of their market depth indicators are a tick behind because they don't account for the fact that the on-bar update occurs before the on-market update, for instance. Apparently, there's a bug in NinjaTrader's cumulative delta that makes it not reset at the beginning of the session correctly, that we discovered with Uzi. We kind of forgot about that after we did that. I don't know if we ever submitted a bug report. Yeah, at least on tick replay works fine with tick replay off. Super bizarre though, right? I think the one funny enough, I think that the indicator that I spent the most time programming on was the market order imbalance. So getting something that does a window but is still performant and deals with all of the different cases for the caching, like, it ended up being really complicated. Because, like, there are little things that you have to do differently if it's on bar close versus on each tick. There's little things that you have to do differently if it is tick replay is turned on or not. And what else? There's nuances that you have to deal with when the indicator is drawing historical data versus live data is the other one. And so all of those things combined, there are so many different edge cases in there to handle. At some point, I'm probably going to have to go back through and double check if I can simplify some of the logic. Another one that really messes things up is that the session iterator has to belong to that class. Like, it can't belong to a base class and you inherit it. That doesn't work. And you can't use it multiple times a bar. It doesn't work correctly. So you get all sorts of... I would only... Well, no, Uzi was the one that caught it. Nah, this one I bet. So the bug is that if you're using tick replay, the cumulative delta doesn't reset at the end of the session, right? So normally, what you would expect to see. Let's see here. This one I have is set to never, so that's probably a bad example. Well, at the beginning of the session, you expect to see the cumulative delta go back to 0. Essentially, right? So anybody that's really actually looking at their chart and paying attention to what it does at the beginning of the session would notice. Uzi noticed. But what I did was I think I understand why it was what caused it. And I'm sure that whoever on NinjaTrader has to deal with the bug will probably have a good afternoon of trying to figure it out and feeling a little bit perplexed. Yeah. Basically, if you load 5 days of tick data, the CD will read 0 at day 5, accumulate through all 5 days, and not reset. See, I wouldn't have noticed it because I don't set my cumulative deltas to reset on session. I'm just showing the total cumulative delta from the beginning of the chart. But I think the thing and where I'm kind of going is that what I've noticed is that the market really rewards those tiny little nuances. Like the big things, everybody catches them, they're already taken out of the market, right? So it's those little situations where there's one little thing that's a little bit different, gives you an advantage. And those are the advantages that end up really mattering, Cumulative delta for bar period. Well, wouldn't that just delta? I don't know why you would have to make your own indicator for that. You just load up NinjaTrader's order flow cumulative delta indicator. Oh, you want a rolling window. You want a rolling window. Well, that's essentially what the market order imbalance does. Except for that my market order imbalance, instead of giving you like the cumulative delta over the past 10 bars, it gives you the percentage of market buy orders and the total volume over the past 10 bars. Yeah, rolling window is a different thing. There was one indicator where we were talking about it and I was like, oh, I could make a rolling window for this thing, but I don't remember what it was. I did, so somebody asked me to like convert an indicator over to NinjaTrader from TradingView, and it used VWAP. So I did go in and create my version of VWAP. But then they were like, oh, here's how ChatGPT said that they would have done it. And I looked at ChatGPT's code and I was like, well, that wouldn't be entirely accurate. But I'm interested to see what it would do. So what it was doing is, instead of looking at what the price of every order was, it was just looking at the typical price during that bar. So basically the open, close, or sorry, the high, low, and close, and dividing that by 3, like the average of the high, low, and close is typical. And then just assuming that all of the volume in that bar happened at that typical price. And I programmed it up and it was crazy close. The only place on my chart where there was like a significant difference was on Sunday, when there's like hardly any volume going through, right? No, I saw your cost basis indicator vid. Wouldn't that VWAP be more meaningful? No. In my experience, no. So because the issue is that, you know, you can kind of think of it as there's a VWAP for the market maker buyers and there's a VWAP for the market maker sellers. And the total VWAP is going to be somewhere between those two. And so like when you are actually coming to the cost basis and it does the bounce sort of a thing, you know, cost basis will show it to you and VWAP doesn't. Although often they do coincide. And I did a lot of stuff with like, okay, like if the VWAP is below this thing, because that sort of stuff does happen, but wasn't able to make any conclusions off of any of that. I mean, the thing with VWAP, so the reason why retail traders think that VWAP is significant is because there are some algorithms that essentially say, if I'm buying and the price is below the VWAP, then I can buy more aggressively, essentially, right? The issue with that is that the research has shown that just accounting for your impact on the market improves your execution better than VWAP does. Like what started to happen was the market makers and the traders all kind of started to sort out that big funds were using VWAP to execute and started screwing with it essentially. So you know, there came a point where the institutions were really frustrated with the performance of VWAP. It wasn't working for them very well. And that's when they kind of switched to these other execution algorithms. TWAP is still very common though. But this one is kind of saying something different. This one is saying this is the average position of all market makers that have taken on buy-side inventory or sell-side inventory. And ergo, when you reach that point again, if we've been far away from it and we reach that point again, the market maker is likely to do some rebalancing there, which is why you tend to see hard bounces off of it. So I think that we could do some empirical research on this if we had the right data, right? Like if we had data that included like all transactions and who was carrying them out, right? Then we could look at every one of them, everybody that's registered as a market maker, right? And then calculate their average position and compare it to what the inventory cost basis gives us. This is probably what we would do. Because the inventory cost basis is looking at all limit orders to do this math, right? So that is the average of everybody that's taken a limit order. But what does it actually correspond to with the actual market maker themselves? And my theory is that it would be really, really close. There's going to be some situations. So there's one case that we know of, which is like if the market maker stops out of a position, then that line kind of becomes not as effective. But otherwise, I think what I see seems to suggest that it does a good job at explaining where their average position is. So, is knowing where the average position of the market maker useful? Well, I think so, but you gotta be real careful, you know, because your propensity as a retail trader is going to be to think that like that means everything. But the reality is that the market maker positioning is, you know, just kind of like one piece of information that we have. And it's not necessarily the most important piece of information that we have, right? The most important thing that we have is what are the market orders? If you can predict the future market orders, that's like all that matters, right? But if we're not expecting market orders to come through, then where the market maker's position ends up being really, really key and can help you kind of predict what's going to happen. So part of it is, yeah, this is a really, because I think part of it was that's the area that I've struggled with. Like, because we've focused on the market flows and everything, we've gotten pretty good at predicting those. But then when it's a slow day, if I decide to take any trades, I just get slaughtered. Now, with that we've kind of focused on the inventory cost basis a bit more, I don't fall into those traps as easily now. So it has improved things. But the other part of it is that in the retail world right now, everybody's really obsessed with the market maker and the algorithm that runs the market and all of these sorts of things. And so part of why I'm pushing it is so that we can show these smart money concepts guys what's actually happening, because once you actually are able to see what's actually happening and see kind of like how the market maker is adjusting what they're doing based on the conditions, you see that like almost all of the ideas and theories behind smart money concepts are wrong, right? Is there an average amount of time before a market maker would like to rebalance before they realize they are getting upside down? So in my observation, no, but it very much seems to me that they want to rebalance things before the end of the session. So like kind of what happens from what I can tell is when you get to the options close, these guys, they put out all of the inventory that they have. They start showing it on the DOM, and then they negotiate a settlement price. And so one market maker probably makes money on that, and another market maker probably loses money on that because they don't want to hold the inventory overnight, essentially. So they kind of want it to get back to the, they kind of want a bounce to happen before the end of the session. And most of the time you do get it. Most of the time you do get it. But I would say that it's kind of random how long it takes for them to get it. So I wouldn't take a trade with the anticipation that, they're going to rebalance in the next hour or something like that. That doesn't seem to work. They're going to bust that high. They've kind of been buying a little bit again. Trump says he will meet Putin in Saudi Arabia for Ukraine war negotiations. It does kind of look like they've been filling out that volume profile, but that 21.5 will remain the center of it. Overall, though, we have another one of these cases where you get a relatively broad range, and price seems to be extremely sensitive to the orders within that range. So what's this here on Twitter? From the ZNF hashtag, a little bit surprised that 10-year note futures rallied a bit on not so rosy PPI print. Perhaps the market was bracing for even worse inflation news. Alternatively, jobless claims continue to impress. Yeah, but again, jobless claims being low would suggest that you don't need to cut interest rates. So we still don't have a very good explanation for why the treasuries rallied. And continue to rally, frankly. And continue to rally in a way that is more extreme than yesterday. Perhaps, well, okay, so here's a theory. Perhaps somebody was hedged short for CPI and PPI. And after PPI was done, then they were like, oh, okay, we can take our position off. They removed the hedge, and perhaps removing the hedge caused the buying? I don't know. I've never seen one that extreme like that. It's kind of a weird thing. I think one of the things that frustrates me as a creator is that the nature of the market is that the most valuable things that I can give you is the information that might predict that they're going to buy or sell that day, right? And, that's really hard for me to be able to give you because one, sharing that information kind of reduces my own edge. But then two, it's like would want to provide that information to you before your trading sessions. It'd be early in the morning when I'm not awake. And the amount of information that we have access to as retail traders is really, really limited anyways. And, it's kind of frustrating. Like, again, somebody has to trade. I mean, somebody has to do it. But pretty much everything that I know kind of suggests that you probably shouldn't, right? Most people will not be successful with it. It's just, there's no way around that. So, are there other services that I can provide you guys that are worth money and get you paid? Yeah. And it's really frustrating to see like everybody gets so skeptical about the value that you're providing them. And then, everybody just FOMOs in on all of these stupid courses that, outright scammers and other channels are providing. It's just like, what the hell? Oh, there's been a decent amount of activity over here. By the way, did this keep our category? Yeah, it did. Are they? Oh no, they're not quite lining up, but ZN might bust it. I don't know. The activity level is pretty nonchalant for them sitting right there at those highs, isn't it? So like at a time like this, I'm kind of like, oh, hey, maybe we should browse Reddit and see if there's anything interesting on Reddit to read. But like, I'm kind of trying to be on Reddit less. That platform is really starting to become unbearable, man. Like, you just cannot. They have just gone nutso. So their stock has gotten hammered. Actually, let's go take a look at that. I'm interested to see if there's any overnight movement in that one. So like what I've been seeing now is I used to get things where like because you belonged to this one subreddit, you'd get banned from another subreddit. And that never really bothered me because those were usually subreddits that I wasn't that interested in anyways, right? But now I'm starting to get banned from, like, if I've even in subreddits like, well, like yesterday was the ADHD subreddit, right? And if you say something that's even remotely conservative, you just straight up get banned. It's just like, there's like an active purge going on. And meanwhile, everywhere else on the front page is just like hysteria after hysteria, like the craziest thing. So the one that I was seeing yesterday was actually, let's pull this up. Elon's kid, what was this? Um, what picks his nose and wipes it on Donald Trump's desk? No, that's right here. This one right here. Oh, come on. Am I going to show the GIF? Oh, here we go. X that looks autistic to me already. You see this? So they're saying that the kid mouth, I want you to shut up now. And they had all these GIFs of people saying that he was telling Donald Trump to shut up. And I'm sitting here like, how can you possibly read that? Like, the kid is not looking at Donald Trump. If he was looking at Donald Trump, his head would be tilted way over here. Okay, because Donald Trump is basically behind him in this spot, right? He is talking to somebody that is way over here. He's very clearly talking to the reporters. And I go on Reddit, and they're all trying to gaslight everybody into that Elon's kid was telling Donald Trump to shut up. And I'm sitting here like, if you think that he's talking to Donald Trump, you might be autistic. Like, I don't see how you possibly see it going like that. It's just so crazy. And like, this is like all that is on Reddit anymore. This is all that's on Reddit anymore. So anyways, coming over to their stock price. Stocks, there it is, RDDT. Okay. So they were kind of getting hammered anyways. But then last night they really got really bad. But it looks like they're recovering some of it. So we'll have to see where they end. And come back and look at it tomorrow and see where they ended up. Because essentially, it sounded like that they had missed some of the user growth numbers that the market was looking for. And it seems to me like that Reddit is going to continue to struggle in that aspect. Like, unless you are a far left liberal, you probably can't stand the website right now. Like, it used to be that you could avoid the front page and be in individual subreddits and avoid that stuff, but not anymore because they've taken it over. So I'll tell you what I got banned for yesterday was there was a change made to disability protections to basically try and include gender dysphoria into those protections. And so like 14 different states have been suing the Department of Health Services over it. Apparently this isn't the first case like that, so I think that I said something that was incorrect because I was looking at the previous case about this that had to do with abortions. This one is more about gender dysphoria. But in the post on the subreddit, they didn't mention that at all. They were just like, oh, they're trying to dismantle disability protections. It's going to affect you. So I pointed out that, people are being manipulated with it, right? Outright ban. So then I messaged, what rule did I break? I didn't break any rules. I think that this is politically motivated. And the admins literally messaged me back and said, yes, it is politically motivated because you supported a fascist or something like that, right? I couldn't believe how brazen it was that the moderators were basically saying, yeah, you didn't break any rules or anything. We're just preventing you from participating in this sub because you're a Republican. That's crazy. And that's the shit that's going on Reddit. So why would anybody want to, that's not already on that website, want to go and join that website? Yeah, I think that user growth on Reddit is going to have problems. And I bet you that next quarter is going to look even worse. And this is kind of a recent thing because it's really just been since Donald Trump got put in office that Reddit has just completely lost its mind. And I don't know if the people that run Reddit care that's what's going on. It was because of speculations of peace between Ukraine and Russia. Yeah, well, I think that kid doesn't like reporters. I'm sure that Elon Musk probably badmouths reporters and talks bad about the reporters all the time, and that's probably what's it. And also with the way that the kid acts, and that looks like autism to me. So you see, like an inability to understand the social situation and constrain oneself relative to the age of the child, because he's like what, 7, and I think that a 7-year-old would know better than to mouth off to another adult in the middle of a press conference, right? Like my stepkids wouldn't do that, but Asher would, right? if he could talk, he would. I think he seems autistic to me. But then it's this weird thing that's like, why is it that like when Joe Biden was president, that like we need to do everything that we can to shut down misinformation, and we need to have nuance and understanding in everything that's going on, and you know the limits of what the president can and cannot do. And then all of a sudden, when Donald Trump is president, like we're just straight up autistic about things. Like we just interpret everything as bad as we can against Donald Trump, even when it doesn't make any sense from the evidence or context. It's just so wild. And I just feel like that social media is trying to gaslight me. And I'm kind of tired of it. I'm very, very disappointed that internet forums were essentially destroyed and replaced by Reddit, and then Reddit turned into this shithole. Can you pull up the cost basis? Yeah, actually, is it? I hadn't really been looking at it, and I'm all of a sudden I'm kind of like, is this actually my data correct? But it is. But it looks to me like we are in a trend day where the cost basis isn't necessarily really very effective. Like we're actually well above. So when you're having a trend day, what you're going to see is we stay above this line, right? There's the line right there. We stay above the line. That's what's happening here. So like right now, a rebalancing would mean going all the way down to 16.5. But that's because not that much volume has been trading up here. So if this really is another big meta order, I'm not sure if it is, because like look, cumulative delta is not changing there. I'm not necessarily seeing the Japanese yen is kind of slightly up. So I still kind of think that some of this move may be currency driven. So that's another thing, is if it's the currencies driving it, then the existing positions don't necessarily matter, right? But you're probably going to need to see more volume traded up here on like maybe a third leg or something like that. And then maybe these will come up high enough to where it's possible to have a rebalancing. I don't know. But I think that the chances of it coming all the way back to 16 right now are super low, right? But again, you got to know like what kind of day it is. Well, I was not expecting today to be a trend day. I was not. But once you see that, once you see a 30K change in cumulative delta within 10 minutes, you are in a trend day of some sort. Okay, so wouldn't rely on these lines in that situation. Right? The lines are going to be most effective when the market maker is in control. When it's a, a relatively tight ranged day, which is not today. So now would be one thing that you can do with the indicator is you can change it to be like, just show those values within that bar, so that we could try and sort out the cost basis within this range that we've had. That might be more interesting. But this day's news is favors dollars, but that market, I don't know. What would you say is the most meaningful thing to look for in cumulative delta? Well, what you want to see in cumulative delta is high R squared. So strong autocorrelation. You want that to be like, so if I have a line and it's kind of like this, right? Okay, that's R squared of 0. Like there's the past does not predict the future of this line very well at all, right? Whereas if you have a line that's like this, that's extremely high autocorrelation, right? That's an R squared of 1. So the more persistent that you see something like that, the more likely it is that it's being caused by some sort of a large meta order. So that's kind of the sign that I'm looking for in my cumulative delta to say there's some sort of a large meta order being executed here. It's probably pretty safe for me to buy and hold it for a while. Of course, the issue is by the time it looks like that might be over, right? So I kind of want to be able to catch that this is happening as early as possible. And then like once I'm in the position, that's what I want to see. And if I'm not seeing that, if I see cumulative deltas just doing this, then I might just take the quick profit or whatever. So from an algorithmic perspective, there's a couple of ways to approach that. You can take cumulative delta and you can apply statistical measures to it. Like you can run R squared on cumulative delta. You can run correlation on cumulative delta, because the other thing is you want to see that the cumulative delta and the price are highly correlated. If they're not highly correlated, you don't want to trade it. Or you can use some market order imbalance, which is another good way of, this is a way of being able to say, when it crosses a specific number, that's kind of telling me something about the condition of the market, that there's a persistent imbalance. What if price is diverging? So if price and cumulative delta are not highly correlated to each other, you don't want to trade it. That means that the most common situation when that would happen is price is moving and cumulative delta is flat to sideways, right? Which is kind of what we're having right now, right? Okay, so for instance in ZB, okay, say we're running this stuff on ZB, right? Cumulative delta is down, price is up. What's with that? Okay, well, because we're humans and we kind of understand context and everything else like that, we're able to sort out that they're probably spreading. So they're going to buy the 5 years and they're going to sell the 30 years. You're going to get, that's tilt up like this, right? That's steepening. And sure enough, when you look at the spread, they did steepen. So that's probably what's causing that, right? So if you were to say, if your algorithm was, if I get high R squared in cumulative delta, and cumulative delta is declining, then sell, right? And if you did that, you would have been BTFO'd, right? You would have gotten just absolutely destroyed. So what do? We say, what is the correlation between cumulative delta and price? And if it's really high, if it's like 1, then I can take trades off of it, right? In this case, it's not. It's almost the opposite. It's -1. So then I'm not going to take a trade. Although it's kind of rare to see a -1 in any of the treasuries. Perhaps you could create an algorithm that looks for a situation where you're seeing really high correlation. You're seeing really high R squared. Hold on a second. This is Seth. Just the school telling us about they're doing a drill today. Anyways, what was I saying? Oh, I might be able to do something that says, like, look for this situation where cumulative delta is persistently going up in ZF and persistently going down in ZB, and make a trade based on that. We could perhaps do that, right? But while order flow is not the holy grail, I think this is kind of one of those situations, though, where when you really understand it, it actually does a really, really good job at keeping you out of action that's bad, frankly. Like, the kind of trade, like, in my opinion, of course it depends on how you trade. Let me come back over here. Of course it depends on how you trade and which trades that you like. But in my opinion, the best opportunities for retail traders are being able to get into something before a trend happens and then just holding it through that trend. That is, you know, those are really good trades. You get big winners. They're really easy to hold. And I do think that, like, in terms of like edge that is available out there for you, that it's easier for you to predict those than a lot of the other games that I see retail traders trying to play based on all of these convoluted bar combinations and weird situations like that, right? So I think that those are really good trades for retail traders. And if cumulative delta and price are not highly correlated, then that's not what's happening. So then just don't trade it, right? It keeps you out of bad action. It's really, really effective in that way. You watched the order flow playlist yesterday? Do you feel enlightened? You should feel enlightened. Like after you watch the order flow playlist, you should be like, oh my gosh, I can see the matrix now. Pulling bullets out of the air. That's how I felt after I learned, you know, once I felt like I had mastered that information. How reliable would the bull bear divergences? I'm not exactly sure which particular indicators you're talking about there, to be honest with you. I guess, you know, so going, if I can just take a step back, you know, okay. There's strong autocorrelation in the sign of orders, whether they're market buy or market sells, right? But the orders don't 100% correlate to what the price is, right? So what's with that? Well, because one, market makers inject randomness into the price, and two, there can be correlations. So the market makers might be moving the price based on a correlation in another instrument instead of because people are actively buying in that instrument. Right? So now, not only have we established that there can be divergences, but we can explain the divergences. And that can potentially tell us something about maybe there is a trade, right? Chad says, to be honest, yes, very much so. So isn't it so funny? Like, because it seems like such a crazy claim to make, right? But I think the thing is that once you understand what's really going on in the market, it really kind of destroys a lot of the fantasy that we make up in our head. You kind of start to see it as this really stupid thing that's going on, rather than this wonder that I can explore forever. It's, you know? I tried building out, the data's not available on TradingView. Like quite frankly, for backtesting, the data's not really available in NinjaTrader. So here's the problem that I had, Chad. Is I would say something like, okay, a 10,000 net change in cumulative delta in the 10-year treasury is significant. So if it's gone 10,000 in a 10-minute period, then, and I go long, what tends to happen? Do those tend to continue through or not? Right? And what I would find happen is that the difference between tick replay data and live data is just enough that, like, maybe you hit that 10,000 order threshold 1 minute later. And 1 minute later doesn't seem like a lot, but it can, like, completely change the trajectory of the algorithm. And so I kept running into this thing where the difference between my live data and the tick replay data was just enough that the backtests weren't very effective. And this is the thing with TradingView as well. So what I discovered when I was going through this with Chad and in TradingView was that when you take a trade, TradingView tends to give you the close of the previous bar instead of the open of the current bar, which in most cases is just going to be a 1 tick difference. But, like, you know, it's basically like -1 tick slippage. So normally when I'm testing an algorithm and I really want to see like it's really good, I will tell NinjaTrader to assume 1 tick of slippage to kind of say, well, at the time the chart says that you would have gotten that price, but that might have been just the best bid. And if I crossed over with a market order, I would get 1 tick higher than that. So if I assume that there's 1 tick of slippage, then I really know that I'm safe, right? But what TradingView is doing is it's giving you -1 tick of slippage. So I don't know if that completely explains why the results in TradingView always seem so rosy, but it's a pretty big one, right? But anyways, it's just like those kinds of little tiny things, like getting an accurate backtest is actually like a whole complicated venture in of itself. Which is why I created the indicators. Because then you have all of this caching that works automatically, so it's saving it to disk, and you can do the backtests and see based on the live data that you received what it would have done. So it should be a more accurate backtest. But then the other thing with it, you're talking about, because we're talking about cumulative delta, is that running an algo directly off of cumulative delta is probably not the right way to do it, because you have to deal with, okay, there are times when there's really, really high volume and you're going to see really, really big changes in cumulative delta. And you're going to see other times when there's not as much volume and you're going to see smaller changes in cumulative delta. But there could be a situation where, you know, it's not as high volume, but there's a much larger imbalance. And how do you know, then what? So you need something that kind of, what do we say? Like adjusts to that. It's just like, so if I'm going to take a trade, if I'm going to run an algorithm that takes trades in ES and I have a set stop and target, well, that set stop and target is not going to scale very well. Like I need a set, you know, like that might work really well today. But if I go back in time when the S&P 500 was smaller and so the volatility in terms of ticks was smaller, then those stops and targets are probably too big, right? So you have to adjust for that. Or let's say I have a stop and a target, right? I want to run it on gold now. Well, I would have to figure out a new stop and a target. But when really what I need it to do is I need the algorithm itself to figure out what the stop and the target are based on the properties of the instrument, right? So you could kind of do similar kinds of things with cumulative delta, right? So one of the ways that I've found to do that is to, instead of looking at the net change in cumulative delta, look at the net imbalance. What was the percentage of buys relative to the percentage of sells? And then you have something that's normalized. And that's the market order imbalance. That's why that's so effective in an algorithm. Yeah, rather than a set take profit and stop loss, there needs to be a dynamic take profit and stop loss. Even if, so I was trying, one of the things I was trying when I was talking to you the other day, because I had one set up based on, okay, so like I had the set stop and target, and then I changed it over to using the daily ATR, and that didn't work as well. It just, I've been on some algorithms where that's made it better, but that one it did not. That one it did not make it better. So then another thing I tried was, what if instead of setting it based on the volatility, I just set it based on a percentage of the current price? You know what I mean? But that didn't really seem to change anything. So I don't know if it's just that one, because I've definitely tried it on other things and that's been effective. So I don't know. And I use that kind of method because I know that that's how a lot of momentum strategies work, is that, you know, they identify an instrument that's trending, and then based on the volatility of that instrument, they determine how to size their position. Because then that's the other thing is you want it to scale, right? Like as you make more. So one of the issues, like let's just say, for instance, and this is again another reason why it's really good to have benchmark strategies, right? So if I take a trade and I'm always trading it with one lot, and then I look at the performance of that over a year, and then I try to compare that to the performance of the S&P 500 index itself, that comparison doesn't work very well. Why? Because you're always trading one contract, so you're not compounding, whereas the index is continuously compounding. Every increase in percent, you know, then follows through. So 1% today and then 1% the next day is more than 2%. But so you can do a benchmark with it, right? Or the other side of it is you have to make your algorithm scale. Okay. So here's the issue with that, is that then what you have to do in NinjaTrader is you kind of have to say, let's assume that my strategy starts with $100,000 and I'm going to always trade like 4% is like a good number that you can base it on, right? So now what I want to do is based on the volatility of that instrument, trade the number of contracts that would make it 4%, right? Well, one issue that you're going to run into is that sometimes that's not even one contract, right? So then you're kind of screwed. That's one of those things that's kind of like why I think that, you know, like a momentum strategy, you probably want $10 million to start with. That and for it to work as a business, you kind of need $10 million under management to start with, right? Okay, now you have something that's continuously compounding or whatever. Then what you want to do is you want to have something that trades in all of the different instruments. Well, NinjaTrader will allow you to run the strategy against all of the different instruments, but it won't do it like, okay, here is the overall. It will just say, here's all the trades in this one, and here's all of the trades in this one. And you would have to like take out the individual trades and combine them together to get like a total running profit of that. And then especially to determine like how you would size each one, right? Now the NinjaTrader backtester can't do that stuff. That's where you do it in Python. So those are some of the issues we deal with. But I don't know. I always seem to come back to that, like the edge that's available to me as a retail trader in an algorithm that maybe holds for 1 to 30 minutes. I don't really think that there's really a whole lot of edge there to be had. And even my really good order flow ones don't perform as well as Seth with his discretion and being able to predict order flows, right? But I don't know. Probably like these indicators, because I do think there's some value in these indicators, and I do want to make some algorithms on these indicators. I guess what I'm saying is that the kinds of strategies that I should be trying to build with these indicators should really be high frequency trading ones. It's probably where those are likely to find an edge. Seeing a little bit of a trend popping through here in oil. S&P 500 has been let's say a relatively tight open so far. What about multi-time frame analysis? So I have some indicators that allow you to analyze multiple time frames all at the same time. And I definitely found some strange and interesting statistical behaviors in, you know, so like when I make a strategy up like that and I look at the results that I get, like there's definitely like a random, like there's nothing to this strategy, right? But every once in a while you'll find one property there in the NinjaTrader backtest window that's unusual. And I don't remember what they were with that one, but I did find some things that were unusual. It's just, but the overall algorithm wasn't very good. So, I don't know if the multiple time frame alignment sort of a thing is really actually a useful concept or not. Right? It's just kind of like, it's an idea out there, but. So one thing that I do know of, I I was speaking with a quant trader at a firm, and one of the things that he said he did was they were analyzing all of the different time frames. So it would be like, do it on a 1 minute chart, do it on a 5 minute chart, do it on a 15, on a 30, on 1 hour, and looking for patterns in those, and then explicitly avoiding those patterns, essentially. Like they wanted their algorithm to start executing in a time that was like the least, that there wouldn't be anybody looking for signals there, essentially, right? So that was kind of interesting. That's part of why I kind of, I'm like, when I'm looking for a trade, and it's not like just afternoon sort of a thing, I really would prefer to get in a spot that is really insignificant and quiet, and that nobody is talking about taking a trade there. Benny, welcome to the stream. Thank you for watching. I trade ZBZN, but I use the order flow manually. I wanted to say thanks for the stream. Help me stay sane on days when the screen is not my friend. Well, I think that the thing is that if you're trading a random line, like, you're going to go crazy, right? Now trading order flow is not trading a random line. But there's still a lot of randomness in it. Or like, based on what I've seen, if you really, really understand order flow well, and that's all you're using, you'll break even. Right? So yeah, that's going to be frustrating. And you can have bad days for sure. And I think that you're always going to have problems unless you're really able to detach yourself from the results, right? Like that's the thing that I think is probably messing up the retail traders the most. And I think it's kind of a weird thing because retail traders are always constantly talking about like the psychology aspect of it. And this seems to be the most important part of the psychology, in my opinion, is that you have to disconnect yourself from the trading results. Because if you have this belief that your trading results are a reflection of you, or especially like a reflection of your value to society or something like that, then that's just going to mess your trading up, man. Like, you have to come into this understanding that the chances of you being successful with this are very, very low, and that you can be absolutely amazing at this. You can be absolutely amazing at this and still lose money simply because the deck is stacked against you so hard. So if you lose a trade, or it doesn't necessarily say anything about you. Doesn't mean that you can't improve. Like, at the end of the day, you took the trade, so you have nobody to blame but yourself. But it doesn't make you more or less valuable in society. And that's kind of the issue too, is that like it happens the other way around. Is a retail trader will have some success and it all goes to their head, man. They go, well, see, because I am a profitable trader, I am now more knowledgeable and better than all of you. And those people, that usually causes you to blow it eventually. You know? Like, if you do have success, just assume that it was luck. With the market order imbalance indicator, is there a set percentage threshold to use that may indicate imbalance? May have, like, yes. So 55 and 60. So I have tested with 60, and it does depend on the time frame that you're looking at, right? So like, what is the time frame of the main chart? Like, are you doing 1 minute or 1 second? And how big is the window, right? So those kind of things matter, but I've generally found that like a really, really strong move is 60% imbalance, which is kind of curious, right? That like on a really crazy uptrend, it's maybe only a 10% imbalance between buys and sells. Is kind of But then just comes back to this thing that I keep trying to say to you guys, which is that orders have very strong impact, right? You look at the square root law. What is the square root law of meta order impact? It essentially states that the F of Q, or sorry, I of Q, we don't use F, we use I, we use the impact of an order size Q equals Y, which is a scalar unique to that instrument, omega, which is the volatility of that instrument, times the square root of Q, which is the size of our meta order, over V, which is the volume during the period. And if we were to say, what is the impact of 1% of the volume, 0.01 V, so what is the I of 0.01 V, equals Y omega square root of 0.01 V over V. The V's cancel out, so it is YO the square root of 01. And what is the square root of 01? The square root of 01 of 0.01 equals 0.1. So you get Y omega times 0.1. Okay. In other words, 1% of the volume results in 10% of the volatility. Right? Because this is volatility. Right? Volatility times 0.1. Total volatility during the period, 10% of that is caused by those orders. All right. So orders have a huge impact. If you're trading in a range where you have this liquidity whole thing going on and you're like the only person trading it, your order matters. Yes. It has an impact on the market because the market becomes very, very sensitive to orders in those locations. So 60%. Are you going to go long 25 half? Oh, that's interesting. I mean, I think that the call is long. I mean, heck, we could have taken this really at any time since 20 half, couldn't we? We could have just held it all session. It wouldn't have been the best trade, but it would have worked. But again, I don't know what's causing this, so I'm just not going to touch it. I'm not the informed trader today. I think that the way that this has moved is really perplexing to me. I cannot. Usually by the end of the day I can explain it, but today I cannot explain what caused those flows. We only know that those were the flows. The flows were that a lot of market orders came in long. a lot, like 30K all at once. Hmm. Now, I guess another corollary to that is 50 is basically like nothing's happening, right? So, kind of seems to me like that at the moment nothing's really happening. The dollar's moving, so maybe there could be some more in the next hour. Setting standard, well, but I will do dynamic ones. I'm gonna do dynamic stop loss and take profits. I gotta tell you though, man, like, okay, so especially these things that's like, okay, we take a trade and then this take profit is going to be this previous bar's high and the stop is going to be below the structure and all of these sorts of things. Doesn't change anything, man. It's still just random. Like at the end of the day, we haven't done this formula in a while, so let's do it. We're going to assume that your strategy is break even. So, your average winner times the average win percent minus average loser times the loser percentage. And if you are break even, that equals 0. We can then come in and we can kind of simplify this a little bit to have less variables, because I got like less variables there, right? So first of all, I can express the loss in terms of the win. So the percentage of win for all loss equals 1 minus the percentage of win, right? Okay, so we can just use P. And we can also, this average win versus average loss, we can just express that as an R factor. So we say R equals the average win over average loss, right? So now you get I kind of want to pull out my notes in here. There's a lot of simplifying that you can do here. But essentially what, okay, so now you can get rid of this. You can say these are equal to each other now, right? So that actually means like your winner times P is equal to your average loser times P minus 1. Right? Average win over average loser is R. So I think that then we get to, we want to get L over here. So I think that I times this by P. So it's like W equals LP minus L. And then this is actually LP squared, and this is LP, I think, right? Oh, no. It's been a long time since I've tried to go all the way through this. But I think that that's correct. WP equals LP minus L. And then I want... Oh, and actually, I don't want to do that. I don't want to simplify that. I want to get the L over here. WP over L equals P minus 1. Then you get the P's, I don't know, with themselves. I don't know. Somehow it simplifies to P equals 1 over 1 plus R is what it simplifies it to. Okay. So yeah, I probably shouldn't spend too much time trying to recut. I have a video where I show you how how they simplify, okay? I have a video where I show you this, but anyways. So basically, if our risk to reward ratio is 1, so winners are equal to losers, then 1 over 1 plus 1 is 1/2, 50%, right? And what you're going to find is that the probability of any individual trade working out is on average going to come out to being based on what your risk to reward is, right? So if you're setting your risk reward dynamically, it doesn't change that. You just take averages, right? You just say, okay, like on average, what is the stop, and on average, what is the take profit? And you sort those numbers out and they'll come out, and it almost always still comes out to trends towards the break-even line. So these kinds of, now what you have to do though is you don't want a distribution that is like, I only have set ones, so there's only one take profit and there's one stop, and that doesn't work. That doesn't work. You need a distribution that's like what you would really want is a lot of winners right there, and then some of your winners are really, really big. Right? That's the distribution that you want. But what you usually get is a bunch of winners right here, and then the losers are really, really big. That's what most retail traders do, and then that doesn't work. He's taking huge assumptions. So not really, Tilts. So what's really going on here is that you've never done any of this stuff, and I have. And so I kind of know the issues that you run into. So like if I'm saying when this situation happens, this makes it a good entry, right? I want to test the entry itself. Every little bit of stuff that I'm adding on top of that affects the end results to it, right? So in the example that you're talking about, let's assume that it was profitable, which I bet you it probably isn't, but let's assume that it's profitable. Where is the edge coming from? Because you've now introduced like 10 different things in there, right? When really, what are we talking about is the entry. So the best way to test an entry is set the entry conditions, use one contract, have a stop and target that are roughly equal. I bet you that it will almost always come out to be between 50 and 52. Or 48 and 52. Like getting more than 2% is like really unusual. And that's like within the range of randomness too, by the way. So like, right? Another issue is that you believe that a bunch of things have edge without any kind of evidence that they actually do. So for instance, scaling in and scaling out changes nothing. It changes nothing. It might cause a difference from a psychological perspective. Because if you scale in and scale out and you kind of average out those positions, what will tend to happen is it can increase your win rate, but then it will increase the size of your losers, essentially, right? So you'll feel like you're winning all the time and you can keep a positive mindset, but like, here again, like, isolate it, right? We will take a random trade, but we will scale in and scale out with that random trade, right? Like, we'll pick a random time to start it, but then we will like buy one contract every 5 minutes until we've got 5. And then when we've decided that we're exit, we'd take them off every 5 minutes or something like that, right? Or you could even do it based on, it's moved up or down a certain amount before we take on more contracts, right? But have it be on random entry signals so that you're isolating just that one thing, and then you're going to find no edge to it. Because the thing is that I've done it the other way too, Tilt. We'll go in and program every little thing about what it is that you think your setup is. It's still gonna suck. I guarantee you. I guarantee you. Unless it is like arbitrage, high frequency trading, or a higher time frame strategy like momentum. But like indicator soup, guarantee you it's going to suck. And the reason why I will sit and backtest these things for you is to show you the principles of it and why it doesn't work. And it's really funny to me when I show and explain to people why it doesn't work and they still don't believe it. What do you mean you can't take the average of anything? That's not what we're doing. This doesn't make any sense. What are we doing? We are testing specific parts of a strategy and seeing if the results of that differ from randomness. Christy, that's a name I haven't seen in a while. Welcome. Julian says I've backtested scaling in and out too for hours on end and stuff. That's right. I think I actually have the spreadsheet. Oh, I don't know if I would be able to find it fast enough. No, not that. Nah, I think it would be hard to find. I think it was on my old machine. Posted it on Twitter. I basically went through and did all of the math of like, okay, here are the different scenarios. Here is if it's just random. Because the thing that everybody keeps telling me, or not everybody keeps telling me, but like something that a lot of retail traders believe is, like any strategy can work because the edge is really actually in your risk management. So if you just have correct risk management or whatever, you can literally flip a coin and you can make money from doing it. That's bullshit. It's false. But so two things. One, why do people believe that? Because they learned all of this stuff from momentum strategies, and how you manage the risk is kind of the edge in a momentum strategy, but it's a different thing because it's like what is your universe of things and which things are you going to trade and how much do you size into each one of those to reduce the correlation that those things have between each other so that when one thing goes down, it doesn't affect your whole portfolio. And that's what they mean by risk management. And that's why they said that to you, right? That's where they get it from. But if you go through and like list out all of the different scenarios, one is like if I have 3 contracts, like one scenario is, well, and let's just say to make it simple, that you're going to all in at first with 3 and then you're going to take sequential profits, right? Well, so there's going to be one situation where you immediately get stopped out. And there's going to be one situation where you get one contract filled and stopped out. And then there's going to be one where you get, where you take profit on 2 and get stopped out. And then there's going to be one situation where you get all 3. And if you like go through just like the random probabilities of this, because again, they're saying you just have to have the proper risk management and then it will be profitable. Well, when you use this formula again, where you say the probability is equal to 1 over 1 plus R, and you do that for all of the different legs and add it all together, you find that it still comes out to 0. It still comes out to break even. So, like, scaling out changes nothing about that. That's kind of funny because I think a lot of the people like the scaling in and scaling out and stuff like that. A lot of people pick that up from Futures Trader 71, right? And when he teaches that, he straight up says that like it doesn't actually change the probabilities. It's just easier to deal with mentally, right? So it's easier to deal with winning all the time, essentially. Yesterday, I went long too early and kept looking for each little piece of news information. Why would you go long yesterday? I'm sorry, but we need to work on your macro understanding if you thought that yesterday was a day to go long. Profiting from correlation is death after the... Yeah, They had to start the momentum traders had to start using more and more sophisticated methods of analyzing their universe of assets and optimizing their portfolio as time went on. And the most recent innovations have all been around using machine learning to like size your positions and stuff and optimize your portfolio. Anyways. You just said you're using an average take profit and stop loss. Yeah, so what I'm saying is you'll come in and you say my take profit is going to be based on this bar and my stop is going to be based on this bar, right? So every trade, your stop and target are going to be slightly different, right? But I'm saying that if you run it over 2 years, you could take all of those average winners, and what is the average of those average winners, and all of those average losers, and what is the average of all of those average losers, and the strategy will still tend to come back to fitting this formula of 1 over 1 plus R, where R equals your average win. Why did I do it a W? Average win over average loss. Just try it. Just go and do it and try it. I guarantee you it'll come out like this. And there's kind of mathematical reason why. So let me approach this from a different direction. You're still not getting over the key problem, which is that the market on a short time frame essentially acts like a Brownian motion. So if the market underlying there is Brownian motion, then that kind of means that what happens next is random, and like It just means that like the chances of it moving this far are a lot higher than the chances of it moving this far, right? So it's like it's risk adjusted, right? But you're going to find that overall the market is really, really efficient on a risk adjusted basis. So if you do find something that happens more often than it doesn't happen, I can almost guarantee you that when it doesn't happen, you lose more. And you'll say to yourself, well, but I have a stop to stop that from happening. It doesn't work that way because there's slippage and all these other things. And if you set a stop, that will just mean more times that it stops out when it wasn't actually that situation. It all kind of comes back down to it. No, you do have an average. I'm saying you do the back test, right? We did this with a strategy recently, didn't we? So I think I can just do it on advanced space strategy, actually. There you go. Okay, so here I've run a strategy, right? So if I come to my analysis and I look at the net profit, oh wait, we have to I have to save history. Okay. But instead of doing it on daily, I do it on period trades. There we go. Okay. So the size, how much a trade won or lost is different on each trade, right? But you can come into here in NinjaTrader, and NinjaTrader tells you what is the average winning trade and average losing trade. What's the ratio between them? This right here is R. So in this case, let's do it on this one. 0.68. 0.68. So what is 1 divided by 1.68? 0.5952. Well, we got 61.54. It's close. It's 2% off. It's within the range of error. Okay. Now, if you could do something, for instance, where you came out and your average winning trade, let's say that your average winning trade was 2,000 and your average losing trade was 1,000 and your win rate was, P was 60%. Now you actually have something unique, right? If you were able to display that in a back test over, was a 5-year back test and you weren't using my indicators, so you were only using price history of a single instrument. Nobel Prize. You give that to me, we will together get a Nobel Prize. I know how to make it happen. We'll get the Nobel Prize. Well, the Nobel Prize in economics, it's not a real Nobel Prize, but you get what I'm saying. You're not going to find it. I guarantee you. You're not going to find it. And if you do get something like that, it's going to be one of the following forms. It's going to be HFT, which includes arbitrage, or momentum. which is on dailies. I'm saying you need real data of an individual's trading. Well, yeah, but we can write up the strategy and can write the strategy up and back test it across the data and see how it behaves, right? Because what is he really saying here? He's saying that if I go and I program the strategy and I set the take profit and stop losses differently, that the results will change. And the problem that you're getting is that your entry is random. The results of the exit is random. You're just placing randomness on top of randomness. It doesn't actually help the strategy. The case of treasuries with all macro factors, you're looking at it wrong. Or remember, what is the orders? We want to know in the next 30 minutes, what are the orders going to do? So yesterday, what happened yesterday? We had a CPI report that showed that inflation was higher than expected. That means that the Federal Reserve is going to likely to cut or hold off cutting interest rates. That's going to cause interest rates to go up and treasuries to actually sell. So what should we expect the flows to be that day? They should be selling. So yesterday in the treasuries, you should have been selling. Right? But you said you bought. Why would you buy? I don't understand. That means I'm a human HFT. Well, so I didn't finish my list here. I said there's HFT, which includes ARB, market making. That's all I know of. There's Momo, but that's higher time frame, right? And then there is informed trading. Okay. In my experience with informed trading, if you are getting a 50% win rate and an R factor of 1.5, you're doing pretty good. Those are the realistic metrics to meet if you're an informed trader. Okay, so body bag. There's two things. One, I kind of feel like that I said something and explained this to you already, and you're just completely ignoring that. Right? If we come with a strategy, first of all, obviously there's all sorts of nuances in the way that the guy does it, right? So sometimes we have to like work with what we can do or what we know. Okay, but the reason that I do it the way that I do is we're going to isolate the thing they're actually claiming, which most of the time is a claim about an entry condition. So what I will do is I will program the entry condition and I will leave everything else as simple and as it possibly can be, so that the results that we get are a result of the entry condition and not any of the other things. What you should do is, here's my entry conditions, test that. Here's my exit conditions, test that. Take the things that show some sort of an edge and combine those together. Okay? There's this idea that A does not equal profit. B does not equal profit, but A plus B does equal profit? Never seen that. And I don't know why everybody seems to think that that's going to happen magically. That it's like some magical combination of things and then it's going to be profitable. I don't need to, but which theory, what are you saying is my theory? Yeah, you must have gotten bored. Here's what I see. This is somebody that's built their entire personality around some sort of short-term success that they've had in the markets, and all of the ideas and beliefs that they had around that they had at the time when they made that, and they can't handle it when somebody's able to show them that that's all bullshit. That's what I see. But that's the point. You have an entry, but no, you're missing the point, man. You're not no offense, dude. You know what? It just makes me mad. You know what I'm going to do? I'm going to stop trying to be nice, and I'm just going to say what I'm thinking. Pay the fuck attention. Okay? Because I've said this 3 times, and you're not listening to what I'm saying. You're not listening to what I'm saying. A equals, or not equals, A does not equal a profit. A is entry condition. B does not equal profit. B is like exits, or like your stop and target, right? Your claim is that A plus B does equal a profit. And I'm saying, 1, we can program A plus B if you can explain what A plus B is, and I will show you that it still doesn't improve things. And I have literally never seen an instance where A plus B equals a profit when A does not profit and B does not profit. Do you understand what I'm saying? So when we come in and we say, I programmed a setup based on an inside bar, and the results that we got weren't very good. In fact, the results that we got basically said that the setup was like a negative, like you made more money trading against it. So now you're saying, well, it's because you didn't include B. This is your theory. Your theory is that even if your entry condition on its own does not result in a profit, and your stop and target strategy on its own does not result in a profit, that combining those things together can result in a profit. That's your theory. And I'm just telling you, we've done it a trillion times, and that's wrong. You want to go back and go do that? We got 30 minutes. You want to go back and set the stops and targets based on, you know, the bars? No, you explained to me, well, it wasn't you. Yesterday, we went through a setup that was an A setup, right? It was an entry conditions based on an inside bar. It was what we programmed yesterday, right? When we programmed it, we did not include dynamic stops and targets. Now, why did we not do that? Because we want to know the performance of A on its own. If I had programmed all of that up and A plus B was profitable, it could be the case that A does not equal profit and B does equal profit. Why wouldn't I then, at that point, instead of continuing to do A plus B, I go and I find a different entry condition, C, which does profit, and do B plus C instead. That's why when you're backtesting, I'm teaching you something here super fucking useful. You're just completely ignoring it. This is if you go to a quant firm, this is the way that they're going to do it, right? You want to quantify the alpha of every step of the strategy. And then you combine all of the alphas together into one big super algorithm and that's where you get something that's super hyper effective. In order to do that, you have to know the impact of each little step and component. Right? So, what we did yesterday was that we proved that A does not equal a profit. Right? We do not know if B equals a profit or if A plus B equals a profit. My theory is that because it is based on past prices, that B will not result in a profit. Right? So how would we do this? You should have brought this up earlier, and then we really could have programmed all of it. I don't know if we have enough time in 30 minutes. So what we do is we program A, and we have the targets set on something simple, like a set stop and target, for instance, is probably the most simple. But a set stop and target, the results are always going to be the randomness of the market, right? Okay, maybe we can base it on volatility. Okay, then that kind of just gives us an idea, or better yet, if we really want it to be random, what we should do is we want something that is IID, right? Want something that is IID. Independent and identically distributed. So in our case, that is time. Right? So the best thing to do there is hold it for 30 minutes and see what the results of after 30 minutes are, right? Okay. I don't think we did that yesterday. Did we do that yesterday? Maybe we did. I don't recall. I don't think we did. We should do it that way. Hold it for a certain amount of time. Okay. Then we go back and we do another strategy and we say the entry is random, but we're going to base the take profit and stop based on these certain levels that we've got, right? We can see how that performs. Probably it's going to be random. Okay. Then we have proven that A does not equal a profit and B does not equal a profit. Now we can test if A plus B equals a profit. Right? So now I've completely duplicated the strategy and it still doesn't work. Then what? Then what? Okay. But then we have to come back to the bigger mistake that you're making. The thing that really actually makes me mad, which is, why do you think that this would profit when it is entirely based off of price history? And everything that we know is that the market on short time frames in regards to price is incredibly statistically... Man, I'm so mad I've lost the words. I don't even say the word efficient. When everything that we know is that the market is extremely efficient. Okay. You didn't prove anything. You ran a test with a predetermined brackets. You only proved that strat with that bracket. We can program this one up if you say where you want them to be. Right? What so why am I wrong? Am I reading what you said wrong here? What I just read was you didn't test B. That's true. Is that what you're saying? We didn't test B and we didn't test A plus B. Do you want to test A plus B? If I test A plus B and it still comes out to be shit, will you just go away and never come back? Or at least admit that you were wrong? I don't know. Like, come on. Because that's what's going to happen, right? I guarantee you, I'd be willing to bet $1 million on it if I had that much money. That when we backtest that it's going to come out with like a sharp ratio under 0.5. Can almost guarantee it. Like, what should we do here? We're coming back to this thing. Let's leave that alone for a second. Editor. Inside bar breakout, right? Oh yeah, that was funny when we did that, but that didn't actually work very well, so we just no. Get rid of that. Undo that. Okay. So the setup was there's an outside bar, then there's an inside bar, and then we were looking for if it braked out and go the other way, right? So I think that what you would say is the target, the target would be the bottom of this bar, and the stop would be the high of the outside bar, right? Right? Let me open another window so I can copy and paste some code, because I have some code that does that over here. This one, I think it is. Yep. So now after we enter the bar, we can do this. We can say set stop loss and set profit target. Instead of doing calculation mode dot ticks, we can do calculation mode dot price. Dot price. All right. And then the price is going to be underscore. Let's see here. This is a short, so the loss will be inside bar high, right? Inside bar low. And we have to make sure that the order name is the same for all three of these. This one's going to be the opposite. Let's first just change that. Looks like I forgot the T here. So this one is, we're going long, so the stop will be the low and the target will be the high. Oh yeah, we had these right here, right? They're commented out. this one right here. Right. It made some money, but the Sharpe ratio was shit. Right? Load that up. Make sure that everything else is correct in here. There was a... Wasn't there a thing to save? Oh no, apparently we didn't do that on this one. Oh, because we weren't doing any kind of optimization or anything like that. Okay. So here's the results of it before. Here, I'm just gonna like remove all non-pinned. Okay, so here's the one. We got all of the stats about it. Sharpe ratio 0.3%, profitable. We have now changed this. Did worse. It actually never gets there. That's actually interesting. Wait, so I think that actually makes sense to me because, again, like what I've been trying to say is like if you get an inside bar, you're like, okay, so now you break out. Are you going to break out above this outside bar? Probably not. You're probably going to stay within this inside bar. Right? That's really what it's saying. But do I have them backwards? Because it should still happen more often than that. 43... the actually number of ticks isn't like that big either. Winning trade, losing trade. Oh, it was super tight. Okay. Let's mess around with it. Why not? Low. High. High, low. Does that change it, or is it still? It's worse. I think that the issue you may be getting here, though, wow, with that many of them, that's actually really quite startling. That's really actually quite startling. Because they're so small. Like, that never worked. That's actually a little sus. Can I do it on the inside bar high and low? Oh, yeah, let's do it. Okay, I did it on the inside bar high and low. Seemed to work a bit be bad. I think that I'm doing the wrong thing. I think that I want to do the outside bar high and low, right? Probably what's happening is the inside bars are just too tiny that it, like immediately stops out, right? And we got the outside bar. I guess I don't have to, I just need to delete the in, huh? Okay. If we redefine the inside bar, then it must be within the middle 25% of the previous bar. That would be exponentially better. We could change that if you want. But you're still missing the point. It's a little bit better. Like, it's still terrible, but you're still avoiding the fundamental question, right? You're still going on this thing that's like, okay, here we have this huge space of possible trades, and we've come in and we've looked at this one particular point, and we've said this particular point is not profitable. And you're saying maybe there's this other point slightly adjacent to it that will actually be profitable. And what I'm saying is that this entire field right here, which is setups based on price, are unprofitable. If it is based on price, and one series and time frame between 1 minute and 60 minutes, it's not going to work. And I'm just telling you, you can look at as many different data points as you have. We don't have enough time in our lifetime to test every possible little combinations of these that we have. I can make algorithms that randomly try different ones and try to make stuff up to see if something works. There used to be a bunch of firms that did that. They all blew up in 2018. Right? So let's go back to the fundamental question, okay? Input is single time price series. Time frame between 1 minute and 60 minutes. Okay. If that is the strategy, my theory is not profitable. Not let's say economically significant. How can we say it? Because you might actually come out with a profit, but they're not economically significant, right? No economically significant. My ADHD is showing through like I'm skipping letters. Profits. That's my theory. This is a theory. Right? Why am I adopting this theory? Two reasons. One, I've tested literally millions of strategies and I haven't found one with under those parameters. I've found things that are profitable, but like under those parameters, I've never found one with significant, economically significant profits. There are people all around the world that are looking for this and they've never found it. And there is information about the market that is proven that suggests that you will never find one like this. Because on short-term time frames, prices are martingales. If you really want to get into the research about it, right? Right? So I'm saying, because prices are martingales, short-term price are martingales. Right? This is proven. Ergo, if the single input to your strategy is a single time price series of between 1 and 60-minute price bars, you will not find economically significant profits from it. Why do you not believe this? Why do you think that simply changing my stop and my take profit based on the open and close of some previous bar is somehow going to disprove that? Like when you put it in those terms, do you not realize how stupid what you are saying actually sounds? You're literally saying that people for hundreds of years, literally hundreds of years, have been trying to find something that does this, and you're telling me, oh no, it's simple, all you gotta do is use the high of the previous bar. Are you fucking kidding me, man? Do you that sounds so stupid. And you come onto the stream, and you're gonna waste an hour, 2 hours of the stream, me programming that thing up, and then when it doesn't work, then you're going to move the goalposts again. And I kind of thought that, if we just do the back testing and show you the results of the back test, it will show you why what you're thinking doesn't really work. But it never seems that they never get it. They still want to continue to make strategies like that. It's so fucking bizarre, man. I tell you what. I mean, yeah, it's a theory, but really what I'm doing is I'm taking the null hypothesis, right? You're the one with the theory here, not me. Your theory is there is a strategy that uses a single time price series of 1 minute bars that brings economically significant profits. That's your theory. And your theory is that one, and you're using one example, which is like an inside bar breakout. So we've tested a bunch of different things about the inside bar breakout. Here's the other thing. Is like, I've shown you how to do all of this. Like this is the other thing that just absolutely just makes my mind want to freaking explode is I've literally shown you everything that you need to do to be able to write these things and prove these things for yourself. So literally all you have to do is come in and take the code that I've already written and just make the little bit of extra things to get rid of the things that you claim are assumptions that are made, change it to the way that you think that the strategy should be done, and then come and show us and get a fucking Nobel Prize. And you don't do it. Or at the very least, automate it so that you can just sit back and make profits from the strategy, but you don't do that. I think it's your fault these planes. Okay, so then program something up and prove that it works. Like here's the thing. It doesn't bother me when I come in and I make a strategy based on a 1 minute bar and program it up and then shows that it doesn't work very well. Why? Because that's the case with literally every 1 minute strategy ever. And I'm not just talking about the ones that I've tried. There's much, much smarter people out there than myself that do this, and they all say the same thing. There's not edge in this. You're the one that seems to believe that it happens. Like, you know what, Uzi? I really don't think that it's trolling, though. I really think that there's just a really huge segment of retail traders that are just that fucking stupid. Like this particular guy, again, I said, I'm just going to say what I feel and I'm not going to hold back. Everything that this guy has said shows me that he really does not have the intelligence that he claims to be having. Right? Because we've literally handed like everything on a silver platter, and he continues to make these arguments up that just like make zero sense. Like, and honestly, kind of changing the subject, right? Because the subject was always, can we find a strategy that works on 1 minute bars, single asset? That was always the key. And they said, here's one that I think that works. And then when we showed that it didn't work, he's like, we're changing the subject. Most strats really don't work over time, it seems. Well, that's not true. That's not true. Most strats that we are aware of don't really work over time, it seems. Because by the time that we retail traders become aware of it, the edge has been mined out of it. But if we were to take a completely different approach, okay, so the key thing that I'm trying to get at is that the real issue is this. If all you have is a 1 minute time price series, because market makers inject randomness into price, you can't get anything from that. Okay? All we have to do to find a profitable strategy is change that one thing. Run it on 1 day bars. Do order flow. That's not just single time price series, right? That's like, 20 series. Use multiple instruments. So there's this kid, I was talking about him the other day. I remember his name now. His name is Thomas. I don't know what his name on TikTok is, but I'm pretty sure if you go and you search, you find him. Actually, let's go find him. Let's go find Thomas. Because Thomas knows what he's fucking talking about. Here he is. Delta Trend Trading. Oh, come on. There he is. He's this kid with really curly hair. And it looks like my son, except for that my stepson has red hair. I don't know where it was, but he says that he has an arbitrage strategy that was making $1,000 a day. That's pretty good. He was using options, so it's kind of like outside of my wheelhouse. But I deleted my list. He's using arbitrage. He's looking at multiple different series, like the option versus the underlying, and maybe some other things that are who knows what else he's including. But it's an arbitrage strategy, right? Probably if we were looking for like something that just brings us a small little profit, probably we should be looking for an arbitrage strategy. And the problem is just that, like, trying to arbitrage with just outright positions and futures, and there's not a lot of room for that. To get into arbitrage stuff, you probably want to start using derivatives like options, because then there's plenty of places for you to do it. No. That's not how this works. Seth is claiming that there are no profitable 1-minute strategies. That's true. Has he tried them all? No, I have not. So I should prove it, hence Occam's razor. I think that the issue that you're coming into here is that the burden of proof lies on the person making the original claim. My theory is what we call the null hypothesis, which the null hypothesis is always that it's random. In financial markets, the null hypothesis is that it's random. Okay. So the real theory here is that there is a 1-minute strategy that is profitable, right? Have you tried them all? No. In order to prove your theory right, you would have to just find one that works. You would have to just find one that works. Can you find one? You haven't. I don't think that you're smart enough to do that. Kind of seems to me, because like, I tell you what, man, Chad is a smart kid here. I don't know how old he is. I'm just assuming he's a kid because his name is Chad, but he showed me some pretty good stuff. When I programmed his thing up, I mean, it didn't really, I wouldn't trade it or anything, but there was some interesting things about it. I'll tell you that much. There's some interesting things about it, and it had an approach that was interesting. I kind of want to take some of that stuff and see if I can apply it to momentum strategy. And I told him stuff, and like immediately he had a whole bunch of other things that he had done based off of it. You just come in here and say stupid stuff every day. Don't do any kind of work on your own to be like, okay, look, I can show it to you. I went and I took your thing and I updated it and added some conditions, and now you can see that it works really, really great. You're not going to do that because you're too stupid to write code like that. I don't even think you're smart enough to try and go and get ChatGPT to write it and then fix the errors. Yeah, so Occam's razor is not, yeah. Okay. Occam's razor is a problem-solving principle that states the simplest explanation is usually the best. What do you think sounds simpler? 1-minute strategies don't work because the market is Brownian motion. Versus, well, if I have this very specific set of conditions that I have just randomly come up with from somewhere, everything else that you've tried and all of these other people that have tried doing this thing, they weren't able to find it. but somehow I know the exact perfect set of conditions that actually makes 1 minute bars profitable. And I, in my infinite wisdom, have decided to descend upon this stream and give it to you. Which one do you think is a simpler explanation? Come on. Okay, you preach order flow, yet not an ounce of empirical evidence. You require others to prove the order flow works. That's bullshit. Tilts, again, you don't watch this stream. You're either like a really bad troll, you're not watching, or you just don't understand the things that we're saying. If you read this book, Trades, Quotes, and Prices, Financial Markets Under the Microscope by Jean-Philippe Bouchot, Jean-Yves Bonnard, Jonathan Donnier, and Martin Gould, a bunch of French guys, and at the end of every chapter, there is a set of citations wherein they list peer-reviewed journal articles that you can read with data and explanations and everything, proving every single thing that we know about order flow and why it behaves the way that it does. I have an list of empirical evidence in that book that's so large it would probably take you years to read it. But that's kind of the advantage, is what? The empirical evidence that I'm giving you and that I'm relying upon came from researchers at research institutions and universities. And they're publishing it in peer-reviewed journals. Whereas the claims that you are making are just based off of your own experience, and, you know, we would have to write and prove it ourselves to do. Why don't you start a fund with... I don't think you're listening. Again, I don't think that you're watching. Don't think that you're watching. What does the empirical evidence say? Where's my thing? Oh, there it is. The empirical evidence is this. You know what? Like, why am I writing shit down like this? I should just do this. Come over here to this one. Oh. Okay. The empirical evidence suggests this. Markets are very statistically efficient on short time frames. Markets are not very informationally efficient. That means that if you find a statistical aberration, you have to size the position correctly to avoid destroying the edge, and they are very reliable. This kind of an edge, it's probably created by let's do this. It's probably created by market microstructure, and therefore they are very reliable. Markets are not very informationally efficient, which means current prices do not reflect all available information. And information exists everywhere that is not factored in, but your one contract trading on it won't force market to come to value. In other words, trades are much less reliable. Which is why I said the way that you take advantage of this is informed trading. And the stats that you should be going for is an R factor of 1.5 and a win rate of 50%. Because markets are so informationally efficient that if you're winning for 50% of the time, you're actually doing a really amazing job. Right? So why don't I take a fund, take it and start a fund with it? Well, because I don't have anything that's, you know, any kind of an edge like this. They're really hard to find. So we have edges like this, which are things that we can't really program. It's not really the best gig, is it? It's not really the best gig. So what is the real conclusion from this? The real conclusion of this is you probably shouldn't day trade. Or if you're like me, don't risk very much on it. That's the whole point, man. Somebody has to trade. We need more people that understand what's going on, that kind of see these informational inefficiencies and try to make money off of trading them. But it's going to be inconsistent. So that's great that you've chosen to do that you're in the right spot if that's you. Don't risk a whole lot on it, please. Yeah, you can't really program informational inefficiencies because it's an issue with data, right? So like everything that we do as a trader is ingesting data and then analyzing that data and then based on our analysis of that data, placing trades. That's all trading. It doesn't matter whether you're a discretionary trader or not. When you're a discretionary trader, what that typically means is that the analysis that you're doing is pretty complicated and you don't know how to automate it, right? We don't really have that problem anymore because of LLMs, right? Because the things that we're doing that like we aren't sure how to automate them, the reason that we're not sure how to automate them is because they are incredibly sophisticated processes that require neural networks. So once you start to use neural networks, you can program those things. But there's still a problem. You have to have all of the data. So I'm going and I'm reading all of these different articles. I'm interpreting those articles and digesting those articles into individual pieces of information. I don't have any practical way of doing that digestion and passing it to an LLM. So it is a data issue. It may be possible in the near future, because basically what I have to do is I have to make something that reads all of these different articles and digests them into a prediction of flows, essentially, right? Digest them into a prediction of flows. And maybe an LLM could do that, but the LLMs that are like available to me have all of these limitations that make that impractical at the moment. But maybe in 5 years we will. Well, like I said, I mean, here's the other thing, Tilt. That was like, you're talking about technical analysis, right? And I'm talking about a lot of what I'm talking about is what you would traditionally place under the umbrella of fundamentals, right? Yeah, if it's based purely on technicals, it should be testable. Like it's really kind of bonkers to me that like the whole advantage of technical analysis is that it's supposed to be objective and quantitative. And then everybody tells me that I can't actually backtest it. Because really, what when I hear that, what my immediate thought is okay, so you can't backtest it, but you've traded it, and it seemed like it worked for you. And you don't realize that the results that you got are just random. Like, you don't even, like, maybe the decisions that you made were just random, and you just got lucky. I think that's a big part of it. Can we talk about E? I don't know what you mean by that. Elliott waves? Thanks for the compliment. You're welcome, Chad. Chad is like way delayed. It needs to click the live button, but he's in for a bit of a ride because I got pretty passionate there, right? You did a random strategy with a... Like, what are you saying? Like, or is it optimization? Random baselines, timed exits. Yeah. So bars 10. C 1 to 1,000. 1 to 100. Yes. Cool. Dude, look at how amazing of a trader I am. Look, I did this for 5 years. 5 years? Profit factor of 1.22? 50% win rate. Our ratio average win, average loss 1.07. That's okay, I guess. Sharp ratio 0.29. Okay. So what are you saying? Like, coming in looking at the net profit doesn't actually tell you anything, right? Because these results can be random and still result in a profit and still result in something that looks like pretty good, like it tends to go up, right? But once you start to come into this summary of things and you look at some of these other things, then you kind of find that they're within the range, right? Like percent profitable. Like if my profit factor is equal, it's about 1, and I'm getting about 50%, that's random, right? It's not until I start to get like my average win and my average loser are equal, but I'm winning like 55% of the time, and that you start to get into something that's like outside of the range of, it could just be random, right? The Sharpe ratio, it's not until you get over a Sharpe ratio of about 0.5 that it's like, okay, maybe you actually have something. Although it seems to me that a lot of, if you want to start a fund, you want it to be over 1. So yeah. All we were saying is you didn't have all the info a trader was using. No, you're just going back to the same fallacy. You're going back to the same fallacy. You're saying A, which is our technicals, right? Does not result in a profit. But B, which is, you say, all of the other things that the trader has, everything else, Okay. We don't know if it results in a profit. But you believe that A plus B does equal a profit. And well, first of all, we haven't proven that because we would need to see the results of somebody for 5 years, be able to audit it and everything else like that, right? But then if we did prove that this guy was profitable, what do you think is more likely? That it requires the combination of A plus B, or that his edge is actually just coming from B, and that all of this other stuff that he's doing with A is just bullshit and he doesn't realize it? You know how to make the backtest of NinjaTrader faster? Like test 3 years. Yeah, don't use 3 years of tick data. Okay, you don't know if he is profitable, and neither do you. Like, here's the thing. Even if I knew he was profitable, it wouldn't matter. If I can't prove why he's profitable, it's useless to me. Right? This comes back to like this intelligence thing is like, here we're trying to have a very mathematical and empirically evidence-based discussion about things, and you still want to try and turn it into some sort of heuristic about, you know, take it away from the empirical evidence. If we can't show it as empirical evidence, then it doesn't matter. Yeah, I think that that's B. Right? My whole thing is I've been saying technicals are bullshit, and being informed is where you can actually have an edge as a trader. That would incorporate the trader intuition part of it. Because like he knows that CPI was just released and what CPI was. Right? If this guy has a profit and he can't explain where, you know, it's not a systematized strategy that we can backtest, then we can't really prove where his profits are coming from. So it's completely useless for us in being able to prove this one particular point, which is, can you make profits with a single 1 minute time price series? Now, if you're saying really all he has is the technicals, but maybe there's something that he sees in the technicals that includes his intuition. Okay. Why can't we pass the technicals into an LLM, and the LLM will develop that same intuition and be profitable with it, right? But you know what? Like, people have tried that and it didn't work. I think the simplest one was they had this thing where like they would pass the LLM pictures of a chart and then try to have it predict whether it was going to go up or down in the next 30 minutes or whatever, right? And they did all of that testing and it didn't find anything. So there you have an example of scientists trying to test this particular theory of yours and not finding anything. Here's the real question, though. Why do you want to believe it? You think that's wrong. No economically significant results can be found from a strategy utilizing a single 1-minute time price series for trades. You think that's wrong. Why? Why do you want to believe it so bad? Every piece of evidence that we have suggests that it can't be done. Every attempt to prove it has failed. You still desperately want to believe it. Ah, there it is. There it is right there. I don't care. I know what works for me. The reason that you want to believe it is because you think that you've had success and you can't bear, you absolutely cannot stand the idea that it was all luck. That's what's really going on here, Tilt. And I'm just telling you, it was luck. You're not that smart. Whatever results or profits that you think that you had in the past, you probably haven't analyzed them well enough to see that, you know, to know that they're actually good results. And if they were actually good results, it was luck. You think that your results kind of gives you something. You think that it's like, well, I've had this success, so I get to talk about these things because I've had success, and I'm more valuable to society because I've had success with this trading thing. No, you were lucky. You were lucky. And the thought that it was lucky is so damaging to your narcissistic self-image that you'll continue to come in here to this stream and let me heap abuse upon you and show everybody how dumb you are, trying to prove yourself correct. Because having people see that about you and not getting the praise that you deserve for having been a profitable trader, you just can't handle. You just can't stand it. Otherwise, you would just go away. You have to see that. There's no way that anybody would sit there and continue on this conversation and continue to hold this belief in spite of all of the evidence unless they were a narcissist. That's why I'm kind of willing to sit and argue about it. Because the bigger thing I'm trying to show people is that, like, okay, you probably shouldn't day trade or don't risk very much on doing it. And if you are going to day trade, that you probably should try to use an informational edge. And there's all of these gurus out there that seem to claim otherwise. So what's with all of those? Well, first of all, they can't provide empirical evidence, so they can't prove it, right? But why do all those exist? It's because they're narcissists. Narcissists and psychopaths that either are willing to just completely lie to you so that you give them money, or are willing to lie to themselves so that other people will think more highly of them. And that's really all there is to it. I've gone over. It's time for me to go. I'll see you guys tomorrow. Stay excellent, team.